I get the privilege today to talk about the only thing that you don't have to die to benefit from. So life insurance being the topic today and being used to pay for last expenses. First of all, what is life insurance? Life insurance is a contract. So it's contractual property, okay? And so the insurance company, when you buy a life insurance policy, issues you a contract. And it's a contract that say, we promise to pay. And to me, that is a beautiful thing, the promise to pay, because none of us have a lease on life. Annually, Pastor Jim does the, ceremony with the people that we've lost during the year. And the vast majority of them are up there in years. I always notice that there's a few that aren't, and so forth. And so life insurance is really for the survivors more than for the deceased person. And so the responsibilities in this contract with the insurance company has to pay the claim. What does the owner of the life insurance and the insured have to do? Well, first of all, they got to pass a screening to get the policy, okay? And, at Woodman Life, we offer fully underwritten life insurance where you've got to take a physical, order medical records, et cetera, et cetera. We also offer simplified issue for those that may not have the best health. It's just 5 medical questions. Basically, are you in a wheelchair? Are you on oxygen? Have you had a heart attack in the last year? Those sorts of things. And so people can get life insurance if your health isn't so great, just not as much. You see, simplified issue coverage and so forth. What are your responsibilities? Well, pay the premiums. Now, when a life insurance contract is issued, as long as you pay the premium, you hold all the cards. The company cannot cancel it. So as long as that premium's paid, they can't get out of it. And so you hold all the control to a life insurance contract. And if you pass away, you just got a 2-page claim form, like Kimberly was talking about, the death certificate, and that's it. Maybe 2 weeks, and the money is there. So the very thing that created the need for the money causes the money to flow out. To me, this is just a beautiful contract, the promise to pay. Because if you have love in your life and you love other people, to know that your income is going to end when you end, and that you've got the opportunity to make sure there's some money there for your loved ones after you pass away, is just a wonderful, wonderful, wonderful thing. One thing I noticed about this room and so forth is most of us have got a little bit of gray to us and such. And, most people know the life insurance is priced based upon what the age that you take it out. And so I hear a lot of people say, well, I should have done that when I was 35. I should have done that when I was 40. Well, life insurance is a fair deal for everybody. Life expectancy in the United States of America is age 82. So if you buy a policy when you're 42 years old, the company's figuring they got 40 years to collect. So they're going to charge less. If you buy a policy when you're 62, then the company has got only 20 years. So the premium is going to be higher. Is that a good thing or is it a bad thing? To me, it's a fair deal either way, because if you made it to 62, you won, right? Okay? And you didn't have to pay the last 20 years. So if you can still qualify, now maybe you've got your house paid off now. Maybe you've got some bucks in the bank. Maybe you've got your retirement plan set up and you got by without paying those premiums during that 20-year period. And so maybe it's a little easier for you to pay now that you're older, so paying more isn't so bad. Maybe a $200 a month premium is just as easy for a 62-year-old as a $100 a month premium is for a 42-year-old. You see what I mean? So it's really a fair deal for everybody. Now, uses of life insurance. Obviously the final expenses, if you have not met with Kimberly and got that all taken care of already and you pass away, you ought to have at least $15,000 worth of coverage to make it easy for those that have to deal with this, okay? But there are many, many, many other uses for life insurance. If you've got a mortgage on a property, you can use it to pay off the property, okay? If you've got kids that you would like to send to college, maybe you would like to see them kids go to college even if you don't live to see it, okay? If you've got a spouse, like Mr. Reeves was talking about, how he makes the money and his wife spends it, etc., okay? You can leave an income for a spouse, okay? And, I don't want to get too deep into that, but how you can do it, for example, if you leave your spouse $500,000 in life insurance coverage, she can take and invest that. Now, she can't invest like for retirement and pick all the, the options that are riskier. She's got to invest it for income. And so maybe about 5%. So 500,000 invested would provide a 25,000 a year income. If you just took the interest. Now you've got choices on that. You could take the interest plus an extra 10,000. But then each year, now you've put a nail in the bottom of the bucket. It's going to start to flow out. So maybe it lasts 17 or 18 years and then it's gone. If you just take the interest, then it's never going to be gone. Another option would be you could just take 20,000 and let 5 get reinvested and allow it to grow and maybe create a legacy so that income goes on to a special needs child or something along those lines. Equitable treatment. Sometimes you have a family that has a farm or a family business and one child is heavily involved in it. I've run across this 100 times. I used to operate, I've been in business for 17 years, but 12 of it was in Omaha, Nebraska, okay? And there's a lot of corn, soybean, wheat farmers, hog farmers, cattle farmers, et cetera, et cetera. And these people are asset rich and cash poor. The farm's worth $1 million. The machine shed's worth $100,000. The equipment's $300,000. The livestock is such, but they maybe got $100,000 in cash. So they're asset rich and cash poor, and now you've got a father and a son that are in business together, and they're splitting the crop, and it's supporting 2 families, and then mom and pa die, and then the sister that's a nurse and the sister that's a school teacher show up and say, well, we want our third. And so then the son goes from splitting the crop with dad in 2 ways to splitting it 3 ways with his 2 sisters. And so you can use life insurance to balance those sorts of things out and also provide liquidity in the state. You can use it to buy out business partners. For example, Pastor Jim and I are both dentists, and we buy a building together, but we both have our private practices. And if he passes away, I don't want to be in business with his wife. I mean, she's a wonderful lady, but I chose to be in business with Jim, and so I buy life insurance on him so I can pay off the building. The wife gets the cash, the equitable treatment, and now I own the whole building and move on, hire another dentist, et cetera, et cetera. Okay? Another profound use of life insurance is to give gifts to children or grandchildren. Now listen, a lot of people give gifts, and there's a lot of different options out there. There's these 529 college savings plans, there's Roth IRAs, et cetera, but life insurance is the only thing where, let's say you make a $300 annual payment, and then if something happens to the child, now the last expenses are taken care of, and you're taking that burden off of that family, and maybe an extra $10,000 is left so the mom or the dad can take a few months off of work to try to recover from this tragedy. Another thing is, a lot of people think the best savings plan is the one that's averaging 15 or 20% over the long haul, or the one that's super safe, guarantees the principal, and still earns 5%. Well, what I've learned in life is some people are great savers and some people aren't. Life insurance has an aspect to it that it forces you to save money. It comes as a bill, you put it away, you only get a statement once a year rather than once a month or once a quarter, or you're getting emails on your 401k, et cetera, and you kind of forget about it. And then if an opportunity comes along, an emergency comes along, you decide, oh, maybe I'd like to pay that house off 2 years early. There's some money there. And so it turns a bad saver into a good saver in a lot of cases. And you'd be surprised how good of a return you would get on some of these policies, depending on age, depending on health, depending on company, et cetera, et cetera. Gifts to your church, Pastor Jim. A lot of people choose to give a gift to the church. And, I noticed you were talking about how, you leave a piece of property that children like a house or, a car or, a hunting cabin or a piece of land, a fishing cabin or something like that. And then somebody's feelings are hurt. Well, not many people get sentimental feelings towards a life insurance contract. So, one thing that a lot of agents, a lot of, church members, a lot of churches have done is you buy a life insurance contract, but you make the church the owner. And there are 4 parties to a life insurance contract: the owner, the insured, the beneficiary, and the payor. And that can be one person or 4 different people or an entity. Okay? The owner has control of the contract. If the church owns it, that payment is tax deductible to the person that's giving the money to the church to pay it. So it can give you a tax write-off and a tax-free gift to the church. And, you can just give the tithe to the church pays the premium out of that. And then the question comes up, well, what if the person leaves, moves away? Well, the church owns it. They decide what to do with it. They can keep paying it. They can terminate it for the value. They can do whatever they want because the church has the ownership to it. You have given it to the church at the onset of the policy. All right, that's a lot of information pretty quick. Any questions about any of that so far? No? All right. A lot of people know that there are multiple types of life insurance, and I'm going to hit the 2 main categories and then one that's in between just a little bit, okay? There is term life insurance. Now, term life insurance gives you a lot of coverage for a small premium, but it's like renting, okay? It's temporary and it covers you for a period of time, and then you get to the end of that term and you're just walking right off the end of the pier. You understand? But it is tremendous. I love this stuff because, I remember when I was just getting started out in business at the, tender age in my 20s and, wasn't making very much money, but I had big love for my family, big love for my children. I was able to secure $650,000 worth of life insurance for only $40 a month. Okay? And so I had this umbrella of protection over my family. And, in a scenario like mine, where your earning potential is higher than other family members, that can be pretty important because their lifestyle would be completely different without myself. Okay? And so it's cheap. It gives you a lot of bang for your buck. And then there's whole life insurance. Whole life insurance is owning the coverage. You're putting a mortgage on it. It is going to never renew. It is going to never expire. It is also going to have a payoff date if you buy a policy that has these options. And so it's just like real estate, except for it's taxed a little bit different. But some of the features to whole life are it never expires. It's got a guaranteed premium that will never go up, period. It's got a guaranteed death benefit that will never go down, period. It's got a guaranteed cash value that is stated in the policy that will never be less than that. And if you buy a mutual company or a not-for-profit company like mine, Woodman Life, then they share their profits with you in the form of dividends or refunds. And then the cash value can be much bigger than what the guarantee even is. But the guarantee is contractually set. All right, so that's the 2 things that are major categories of life insurance. Now, Unless I got you licensed and hired you, I could not do this. But I've got tall steel file cabinets in my office with hundreds of client files in them. And if we were to get you licensed and bring you to work with me and play a little game of pin the tail on the donkey and blindfold you, opening up one of those drawers and have you walk over and pick a file out, there's about an 80% chance that any one of those clients that I service is going to own both of those types of coverage. Okay? And the reason for that is because they're both tremendous. The whole life will be there when you die, no matter when you die, period. The term is cheap, so it gives you a lot when you're younger for a small premium. And so the mixture is generally the best thing for about 90% of people, okay? You know, and not the case when you're older and you don't have much responsibility and you just need burial coverage, or when you're really young and don't have a lot of ability to pay, then the term would be better for that. But, you know, people that are in the middle of life, generally, a mixture is the best, okay? And then there's a contract, I know you and I had a little miniature conversation about this, Pastor Jim, called Universal Life. Now, universal life is, you know, it's a combination of term life and whole life. And so it's got some of the features of both. And, you know, Pastor Jim asked me once, well, why would you want to buy this? Because it's not guaranteed and some bad things could happen, meaning, you know, if the premium's flexible, it can be set too low and then it doesn't work out too well for you. Well, the reason a person may want to do this is because it has investment options inside of the contract that may or may not do better than whole life. You can tie it to the prime rate in Washington. So if interest rates go back up to 12 or 14%, like in the 1980s, you'll do better than whole life. If you can also invest the funds in an S&P 500 indexed account. Well, the S&P 500's averaged 9% for 100 years, and whole life's going to be about 4 or 5%. So some of my clients want to choose that option. But it's kind of like an old tractor or an old Harley Davidson or something like that. You don't want to go very many years at a time without having me review it and make sure it's working well for you. And so if you just want to buy it and put it away whole life, if you want to have an active relationship with an agent and review it and have the possibility of doing better, then Universal Life very well may work well for you. So hopefully that makes sense. Taxation of life insurance. If you die and these death proceeds are paid out, the beneficiary does not include those proceeds on their income tax return in that year. It is 100% income tax free. Been challenged and challenged and challenged in courts all over the land, over and over and over. The government gives tax advantages to this because they want people to buy it. The government doesn't like indigent people. They like people that are able to take care of their own responsibilities, and so they give tax advantages this way. The cash value inside of a whole life or a universal life policy grows tax deferred. What that means is you never pay any tax on the earnings unless you spend it, okay? And you can make policy withdrawals and you can take loans out that are tax-free. You just gotta be careful not to terminate the policy, because as long as the policy remains in force until the person insured passes away, when they die, it doesn't matter how many loans are on the policy. You know, for example, if the policy's $100,000, you could have borrowed out 80% of it. Well, it doesn't matter. Then when the death proceeds are paid out, it pays the $100,000 and takes the $80,000 out of it, and then the net death benefit is $20,000. You see, and that's paid income tax free. But you got to be careful. You start taking all the money out of it, you want to make sure that the policy never goes into lapse status, because if it does terminate, then it is taxed like real estate. If you paid $20,000 for it and you benefited by 40, now you're going to owe ordinary income tax on that $20,000 difference. Okay? So this stuff really does need to be managed. Now, I've got here in my notes a question, what should you own? Well, if you're like me, the answer to that is as much as I can afford. I mean, I just love this stuff. I mean, it's been a tremendous success for me in my life. I was never the greatest saver, but I buy this life insurance because I love my family, and then it's forced me to save. And it's saved my behind a number of times throughout my life. When able to borrow money from myself. Look, if hard times strike you and you go to the bank and fill out a loan application, what's that loan application going to say? Where are you employed? What's your annual income? What's your debt ratio? And you're walking in there looking for a loan, down and out with your, kind of hat in your hands, not feeling too good, and so forth. And those terms may not be very favorable, but you can borrow from yourself anytime you want. And, you can pay it back. You can pay it back in lump sums. You can pay it back in monthly increments, whatever you can do to get it taken care of. Another question would be, how much should I own? And maybe what can I qualify for? If you've got adverse health, the company may say, we'll only give you $20,000. And that's the situation, then that's the situation. Maybe another company would give you another $20,000. Who knows? Or they may say you can get $250,000. Like I say in my life, the answer has always been however much they'll let me have and however much I can pay the premiums on. You want to be careful though, because you want to make sure that you make a purchase that's going to be relevant to your life. Okay? If you've got people that are financially dependent upon you and you buy a $25,000 policy because the premium's cheap, et cetera, and that's only 4 months worth of income, it's really kind of irrelevant to your life. So I always relate this kind of like exercise, if Sam and I are deciding we're going to get in shape and we go talk to one personal trainer and he says, I got this great program for you and it's only an hour a week. Well, sign me up, that's easy. And you look in the mirror 4 months later and nothing's changed, right? Okay? And you go to another personal trainer and he says, I got a great program, it's 14 hours a week. And me and Sam are scratching our heads, oh my God, how are we gonna keep up with this? But if we did keep up with it, whoa, we're looking good in 4 months. You see, what you wanna do is find a payment and an amount that is relevant to your life, but you can still afford, and you can still afford even if maybe hard times struck and income went down 10%. Even if your overtime got cut, if hours got cut, or if your health is such that you can only work 30 instead of 40 hours, that you would not lose the coverage in that scenario. Because the best policy is the policy that's enforced when you die. You have a policy for 10 years and then lose it, it kind of becomes irrelevant to the situation. Advice in other financial areas. I want to keep close to the scope that Pastor Jim asked me to speak on, and so it's predominantly, final things and taking care of business, but I just want to briefly let you folks know that I give financial advice in many other areas as well, okay? I'm one of the local experts in long-term care solution planning, okay? And, I tell you what, since I've been in South Carolina, I've lived in South Carolina 3 times in my life. The first time was when my dad got his orders to come here in the Navy in 1976. Second time when I was in the middle of my schooling, and the third time was 5 years ago, permanently now. But, a lot of families are like the Waltons, in the last 100 years, where you've got 3 generations living in the same home. Not as many anymore. A lot of times you'll have a child in Massachusetts, a child in Florida, et cetera, et cetera. Maybe you're lucky if one is local, okay? And then, maybe you're lucky and you've got a situation where you've got a couple kids living on the same property with you, and they say, Mama and Daddy, will never let you go to the home. Well, that may not always be in their hands. There may be a doctor that comes along and says the level of care that you're providing isn't good enough. I'm prescribing something else. Okay? And so, this becomes a big issue, and I could go on about this for an hour, but I'm going to move on. We have tax-deferred alternatives to CDs and money markets. A lot of folks say, I don't want to take risk. I don't want to be speculative with this hard-earned money. Mama and Daddy worked 50 years, left me $100,000. I'm just putting it in a CD in the bank, or I'm putting it in a money market. Okay? Well, the problem with those instruments is each year you get a 1099, and you've got to pay income tax on the earnings. Well, I've got instruments where it's just as safe, spits out very similar interest, and again, it's tax deferred, so you don't have to pay any tax on the interest earnings until you spend it. That can make a big difference over time. Can make a real big difference over time. Okay. I also do Medicare supplement coverage, and that is, they advertise these Medicare Advantage plans on TV constantly, and you can sign up for those, and some of them have a small premium, some of them don't have any premium at all, so forth. They got nice prescription drug plans with them, but, you could be out of pocket for $7,500, $8,000 if you have a really bad year and some surgeries and so forth. Medicare supplement is, another name for it is Medigap. If you have Medicare is going to pay what it's going to pay, and it's going to pay 80% of just about anything, okay? A Medicare supplement policy pays the other 20%. That's why they call it Medigap. And so if Medicare pays the Medigap, and it does not matter what company it's with, Blue Cross Blue Shield, United Healthcare, Woodman Life, Mutual of Omaha, these contracts are mandated by the government, and they have to pay or they're in trouble with the government. Retirement income maximization. Now, most of us don't have defined benefit pensions anymore. That was traditionally one of the great things about being in the Army or the Navy. You spend 20 years in the Army or the Navy, and then you get a check for the rest of your life. Well, they phased that out now. These people get a 401k just like if you're working at, the local factory and so forth. And so, and what that did was it took the burden of retirement off of the employer and put it onto the retiree's shoulders. Now you're responsible for deciding how much you put into your 401k, what investment choices you're making. Nobody else has any responsibility in this but you. It's not on the company's shoulders. So, I like to meet with all my clients and talk about this and talk about when you want to retire and other things that you can do. You can use life insurance, you can use annuities, you can use Roth IRAs, these sorts of things to supplement what you have at your employer and accelerate your retirement age or accelerate your retirement income. Okay? I also do pension and profit sharing plans for small businesses. And, there's a lot of small businesses that are, out there and they got 4, 5, 6, 10 employees and just love the employees. And they're given a big bonus at Christmas every year, for a tax write-off, et cetera, et cetera. And then these employees, go to retire and their lifestyle's only 60% after retiring of what it was when they were working. If you set up a small business pension or profit sharing plan, every contribution you make is deductible. And a lot of times it ends up being a situation where you get so much tax savings from the contributions that you're making to the employees' accounts when you're matching their contributions, it pays for 3/4 of your own contribution. There are a lot of advantages, and it's very enlightening to go through this analysis as a small business owner. And I also do IRAs, and that means you can start an IRA fresh. The minimum is $1,500 with most financial institutions to start an IRA, and then you can do a monthly contribution of $100 a month or whatever, or you can just do it at tax time and put $5,000 in it at the end of the year every year. I'm also talking about rollovers. You work somewhere for 15 years, you're in their 401k, and the company dries up, or you get a better offer, and now it's just sitting there, and maybe it's not working as hard as it would be if we were sitting at the table working on it once a year. We can roll that money over into your own personal IRA and make sure it's working hard for you. Some say, I don't need life insurance. And, sometimes they got a pretty good point. I meet some people through the years that got some pretty deep pockets, and, they could just, do what Jimmy Reeves was talking about and, put a child on a bank account and write a check for this stuff. But, sometimes people retire with a net worth of $2 million and they kick up their heels, do a little traveling and kind of like it, keep on traveling. And that money goes faster than what you would think it would, okay? And then sometimes you have like a husband and wife and one of them gets really ill, and bless her heart or bless his heart, the one that's in better health does their absolute best to take care of the other one, but now it's starting to affect their health. It's starting to affect their physical health and their mental health. And then they have to hire a home health care agency. And then they go into assisted living. And then one passes away and the other one's in a nursing care for a number of years, and whoops, after this is all said and done, there went $1.7 million. And so you may have a couple $1 million at age 65, you may not have it at age 89 or 90. And so I always relate this to, I was also a contractor for 15 years, and I worked out of a shop and we had work trucks, and the guys would always say, what tools do we need? My philosophy was always, it's better to have it and not need it than to need it and not have it. And so if you don't need a life insurance policy, but you buy one anyhow, I will guarantee you that's not going to be the biggest mistake you've ever made.